Singapore has emerged as a physical beachhead, I should say, for exchanges looking for the launching of derivatives products in Asia. You've got the China-backed Asia Pacific Exchange saying it'll start trading in the city on May 25th. This is the latest foray into overseas trading venues by mainland investors. Let's talk about the competition with Michael Sin, who's the head of derivatives at the Singapore Exchange. Michael, what about the competition?
Well, you know, the fact that we've got one more exchange opening in Singapore, it'll be the third exchange, is, I think, testament to the fact that Singapore's made very good progress in establishing itself as both a sort of gateway and a harbour within the global market network. So I think just as we've got many hotels, we've got many airlines operating out of Singapore's network, it's a really important thing for banks, for brokers, for traders to be established here and have at their service a number of exchanges serving different parts of the market ecosystem.
You're not concerned about overcapacity?
I would say this about the way exchanges operate, which is that the world of markets is connected through one very large network. So if you have a competitor who's an exchange and he's operating in a different financial center, that's probably less good for you than he's operating next to you. Because what happens then is many of the people which service the end client conglomerate themselves around your exchange, and it makes where you do business a more competitive business center. And it's all about solving for client needs, and sometimes we forget that.
Okay, that's very interesting because, you know, that sort of cluster model being beneficial. What about something like iron ore then? Because you see the competitors cropping up with the Dalian market being open to international investors, Hong Kong, HKX also launching iron ore contracts towards the end of last year as well. Has that materialised in meaningful competition for you?
The iron ore market's actually a relatively young one, so it is still very much about the physical movement of ore between the miners, and China is the largest consumer of seaborne iron ore. And therefore today, if you look at the market structure, there's two quite distinct and complementary markets. There's the seaborne US dollar denominated market, which floats on boats between places. And then there's the onshore warehouse or port stocks market denominated in RMB, which is traded primarily out of DCE. So the fact that DCE is internationalizing is a very good thing, because when market liquidity interacts between two centers like that, which are so different, you know, retail and institutional, RMB and US dollars, you tend to see better price formation, you tend to see more perfect information flow. And we've got Iron Ore Week coming next week. We've got many of the key participants, miners, mills, regulators coming to Singapore, including the DCE exchange. And we're looking forward to having, I think, a very interesting first iron ore conference post-internationalization. So quite excited about that.
Yeah. What about any excitement with regards to some of these Chinese stocks being, Michael, included into MSCI's indices, or some of MSCI's indices, and your own A50 contract as well? How did the sands shift?
So both, in fact, the movement in iron ore and the inclusion of A shares into MSCI emerging markets and MSCI China, these are all very much congruent with the idea that over a meaningful period of time, China will continue and progressively internationalizing both its currency and its capital markets. So the immediate impact of the admission is small because the weightage is small, but it sends a very strong signal. 48 out of the 50 stocks in the A50 are part of those 240-something MSCI stocks being admitted. It means that MSCI emerging markets, which, as you know, is the benchmark for emerging market investments, is now increasingly Asia-weighted. Today, it's about 70% Asia. As Chinese shares, A shares get included, the total capital structure of China now gets more properly incorporated in EM, and EM becomes much more Asian in focus. And therefore, the price formation for a lot of these key global benchmarks will be much more centered in the Asian time zone, and that's good for Asian exchanges like Singapore Exchange.
That's the word on China. I'm sure we'll return to it. But what about India? They cancelled a lot of their overseas licenses in February. What impact is that having on your business?
Well, overall, India's weight in emerging markets is about 8% to 10%. We've seen continued investment into EM But over the last 2 months, I have to say there's been some deleveraging as a result of market volatility. In the medium term, we see that it's an excellent thing for emerging market investors to have choice, both between China, India, Taiwan, North Korea. And the business that we've seen in terms of open interest and volume in India has actually increased tremendously in the past month or so, as a lot of the uncertainties over capital weights, over currencies have started coming off.
That's great, but how's your business being affected?
It's not been affected, except that I think, fear of deleveraging has meant that risk has been taken off the table. So what you'll see in the statistics of what we do is open interest has come down a little, but volumes have gone up. More importantly, what happens is that hedging in currencies has gone up. So our hedging in our Indian rupee, our hedging in RMB, as a consequence of these fears of currency volatility, we've seen record numbers even in the past week. I think it was 3.5 billion a couple of days ago in Indian rupee. So it's testament to the fact that a lot of risk management needs to happen around portfolio allocations.
Michael, I want to move to Malaysia. It's been an extraordinary couple of weeks, obviously, but specifically when it comes to the currency, the SGX came under quite a bit of criticism when it launched ringgit contracts. Malaysia's central bank saying it's not an international currency, it should only be traded onshore. With the new dawn and the new government, what are you expecting?
It's very hard to make an immediate call on what the international capital markets for Malaysian assets would evolve into. But I think what you've seen is overall levels of participation in Malaysian government bonds and the stock market and the currency have remained fairly steady. Right? It's well within the normal bounds for an emerging market type movement. So we've seen no significant movement in investment stance for Malaysia's position in Asia and for Asia's position in emerging markets. And I don't believe that there will be any significant change in Singapore's role or even London's role in terms of channeling international investments into Malaysia. And I don't see any change for Malaysia's attractiveness as an EM destination.
A vote of confidence there. Your CEO has made it pretty clear there's ambitions for SGS to become a multi-asset platform. What should we be watching out for in terms of the areas of priorities?
So the key assets that we want to expand into, which is, again, very much congruent with Singapore's ambition as a financial hub within Asia, is in currencies and commodities. And as I mentioned earlier, the amount of currency trading that's happening on SGX and in Singapore has increased tremendously because we're coming to the end of a period where interest rates have stayed very, very low, perhaps artificially low. We're heading into a period where, with trade barriers and capital barriers sometimes moving in different directions, currency risk has become very, very important. In the commodity space, in other words, in the marketplace for moving physical things from point A to point B, we're seeing exactly the same phenomenon happen, which is in order to trade cargo, to buy and sell cargo, you also need to buy and sell and hedge your freight, your ability, your cost to move products from point A to point B and translate that cost. So across all three of these important risk markets, currencies, commodity cargo, and commodity freight, we see tremendous growth ahead, but for both Singapore and Singapore-based exchanges like ourselves.
The Pope had a missive, didn't he, about derivatives, and it's not the first time that popes have talked about these financial time bombs, as at least some people have called them. What do you think the next blow-up is going to be? Are you worried about anything, Michael?
Not a forecaster, because I work in an exchange, but I would say in very general terms, having come back from a 2 or 3 week visit to institutional investors in Europe and in the US, over long periods of time for institutional grade investors, what turns up as a macro risk consideration is what happens when dollar interest rates start heading up perhaps unexpectedly high. What happens when capital flows, which have moved in a certain direction, start potentially reversing. And in that scenario, we saw that in Asia, perhaps, in '98. We saw that perhaps in the global financial crisis in 2008. There's a very clear pattern of flight to quality, increased volatility, and increased risk aversion. So as exchanges, you're well prepared for those scenarios, but marketplaces have to function well in order for risk to be transferred and for credit to be mitigated. So derivatives play, obviously, a very important role in that kind of scenario. In fact, the specific response of international regulators after 2008 was to make sure that exchanges stood in the middle of a lot of the OTC derivative market and brought those markets onto exchange. So I do believe we're better prepared for the inevitable next financial hiccup.